Are you a long-term investor? If you are, you've got to make sure that you're doing these three things. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so if you're investing, okay, then I'd put you into three categories. There isn't one that's right, one that's wrong. You're either a trader, where you are comfortable buying and selling individual stocks fairly frequently. You're probably dabbling in crypto. You're probably, dabbling in, small cap stocks or maybe tech stocks, something like that. You're buying and selling all the time, very comfortable with that. Okay, so that's a trader, and that's how you invest your money. And that takes a lot of time, takes a lot of patience, and there's a lot of research and all that sort of stuff. Hopefully you've got a strategy, swing trading, call options, something like that. Okay, so you're a trader. That's one. Two, you're an investor where you invest for the long term. It's likely not individual stocks. It's likely mutual funds or exchange traded funds. Hopefully you've got a strategy there too. We're going to talk about that. That's who I'm talking to. I'm talking to you investors. Now, Charlie Munger, probably one of the most well-known investors of our generation. He is the kind of leader of Berkshire Hathaway with Warren Buffett. Charlie Munger says the big money is not in the buying and selling, but in the waiting. So he would actually argue against traders. That's not their strategy. He's an investor, long term. Buy really good companies and then just wait for the long term. They'll go up and down on a daily basis. Economy, the markets will change, but just wait. If you bought a good company, if you got a good investment, just wait. That's the key. So that's second. This video is for you. But then third, by the way, are savers. And savers are not comfortable trading individual stocks for sure. And they tend not to be comfortable with the long terms, the ups and downs that you'll experience as a long-term investor. And so they're much more comfortable in an interest rate investment, something very safe, very secure. It doesn't matter who you are, okay? Make sure that you've got the right strategy in place for you, because I see big problems when people have identity crisis, when they're a saver and they try to invest, or gosh, savers that hear something about people making money in cryptos or call options or whatever, and they start doing that. When you have identity crisis, that tends to get you in trouble, okay? So work with the CFP, make sure that you've got the right strategy for investing in whatever category you're in, and that it fits with your overall financial plan where you're trying to go for the long term. If you're a trader, do you still need a CFP? Absolutely. Managing taxes. How much do you need to have saved up before you can retire? How do you manage your cash flow? Oh my goodness, absolutely. Savers do as well, and of course, long-term investors do. So I want to talk to you long-term investors, okay, really quickly. If you are a long-term investor, if you're an investor, you've got to be doing these three things. This is essential. Now, it's much more than this, but I was just thinking the other day, these are the three things that you have to do. Number one, you have got to be investing in a diversified mix of great investments over the long term. Now, you might say, well, that's obvious. I know it is. However, we see lots of folks that come in to meet with a certified financial planner for the first time, and they're definitely not traders, and they're not savers either. They're long-term investors, and they set up their 401k, or they rolled over an old retirement account into an IRA, and they didn't pay much attention to the mix that they were in. They just sort of assumed it was working, or it was working at that very point in time, or maybe there was a crisis going on at that moment, and so they didn't want to expose themselves to that. They knew they were long-term. I'm not going to need this money for a long time. I don't even love looking at it. Maybe once a year, a couple times, maybe once a quarter I'll look at it. But they never took the time to say, is this properly diversified, and is it structured appropriately for my long-term financial goals and financial plan? Maybe they thought they did. Maybe they were relying on someone to help them guide them in that. But that person that they trusted wasn't a certified financial planner that was doing comprehensive planning, and so they never got the right mix. Guys, I'm not kidding. We've had individuals that have come in and said, "Yeah, my 401k just doesn't. I've got this old 401k, it just stinks. I got to get the money out of there." And we look, and it's just been sitting in bonds. Oh well, how did you make the investment choices in here? I don't know. I just had someone set it up for me. Or, for decades, it's been sitting in low risk. We've had people come in where it's all just in small caps. Why? Because when they signed up for the 401k, small caps were doing really well. But they've never looked at it since. They just thought, well, I'm in a good mix. And it's just small cap or small cap value. You need to work with your certified financial planner, figure out what the right recipe is, what the right risk level is for your long-term goals, for your financial plan. Then have a strategy to achieve that mix. We recommend having a solid group of diversified funds, index funds, low-risk funds, that over long periods of time have performed extremely well. We've got a 12-point inspection, fiduciary inspection that we look to make our investment choices. And then that's complemented with a momentum strategy. Momentum strategy has not done well this year. Momentum has been out of favor. Momentum's moving too quickly. For 2 weeks, this is working, then that really doesn't work. Then it comes back in favor. It's moving way too quickly for a momentum strategy, a trend following strategy. But it worked fantastic last year, and over its history, it's worked very well. So, diversifying, so that not each of these are going to move in the same direction at the same time, but how it's all connected to your long-term financial goals and financial plan. That one was obvious, okay? That's the second thing you need to do. This one's also obvious, but we see people miss it all the time. You've got to set your investments up to automatically reinvest. Automatically reinvest. Even if you are investing in high growth, okay, very aggressive, and you say, well, geez, we don't get a lot of dividends here. These are tech companies. There's not a lot of dividends. What if Apple all of a sudden says, here's a dividend, because we don't know what to do with cash, okay? So you've got to so it's happened, right? You've got to make sure that your account is automatically set up to reinvest the dividends. Because if you're just going to set this thing and forget it and only tune into it once a quarter, maybe once a year, you're not going to tell in that short a time period, oh, wait a second, do I have, $1,000 more in cash than I should? Do I have, did $1,500 just get paid out in dividends last quarter that's just sitting there not doing anything? But if you have those dollars, automatically automatically reinvest, so that when those dollars, the interest is kicked out, dividends are kicked out, they're buying shares automatically. That will compound over time each year. Every 10 years, every 20 years, that will make an enormous difference in the amount of wealth that you can accumulate when you're automatically reinvesting. What if you say, I'm not using anything that has a dividend? None of it. No, I'm not using any of that. There is no dividends on these things. You still need to set it up for automatic reinvest. Why? Because capital gain distributions, even index funds, but certainly actively managed mutual funds, every year mutual funds themselves, they don't pay tax. So they've got to pass out capital gain distributions. And when that's passed out, sometimes that just gets flushed out in cash. It's got to be reinvested, so you don't have what are small dollars at any given moment, but accumulate over time. You don't have those dollars waiting safely in an area that is not consistent for your long-term investing goals. So reinvest those interest, dividends, and capital gain distributions. And then the final must do for long-term investors, I've already slipped Freudian slipped and said it a couple times, you've got to automatically rebalance. What happens when in that first point, you sit down with your certified financial planner, say, hey, yep, I'm 40 years old, I'm going to be retiring, when I'm 60, 65, something like that. And so right now it's just having the right habits, saving the right percentage, and then making sure that I've got the rest of my financial life in order. And so I'm saving, that's long term. So you set up an investment strategy like this, okay? And you've got high risk, you've got lots of large cap, you've got small, you've got mid, you've got international, you've got emerging markets, then you've got a momentum strategy that's moving around, trend following in all those areas to overweight and underweight, and you're good, okay? But what if we go on an absolute tear where large cap growth, which has happened, outperforms dramatically, okay? And areas like real estate underperform dramatically. Well, if you don't automatically rebalance, all of a sudden, those areas that have just gotten really, really hot or possibly could overheat now take up more of your portfolio than you originally intended. And what is at this cycle underperforming now has very little, okay? The way to make money is, yes, I agree with Charlie Munger, is buying good investments and just being patient, trying not to touch them, okay? But it's also buying low and selling high. Well, the way to do that is automatically rebalancing, not based on your emotion. So when large growth or tech, for example, is going on an absolute tear and it's up to here, you trim some of those gains automatically. And if real estate has underperformed, i.e. last year, those gains from large growth will be reinvested in that area that hasn't performed as well, possibly at just the right time to catch a tailwind and then go on a tear like real estate has done this year. Does it always happen perfectly? No, but you've got to be unemotional about it, set it up to automatically rebalance so you're not taking more risk and that you can capture that buy, sell high and then buy low, that rebalancing process. Do that, I'm going to say, at least twice a year. Sometimes annually, sometimes at least in my 401k, I set that up to automatically do it quarterly. Within your 401k, you can set it up automatically. If you're using a certified financial planner to help manage some of your assets and life savings like we do here, they're going to set that up automatically as well. You shouldn't have to think about it, but make sure that that's in place. That automatically rebalancing can make all the difference over the long term. So that's basic. For you long-term investors, those are the three things that you have to have done. Your investment mix needs to be consistent with your risk tolerance, time horizon, your long-term financial plan. That's one. You need to automatically reinvest capital gains, dividends, interest, that sort of stuff. And then you need to automatically rebalance to snap that allocation back into place. That's the foundation. That's the basics for you long-term investors, how to build compound wealth, significant wealth over time. If you need a CFP to help you with that overall approach, talk about your investment strategies, make sure that you've got those honed in and that you've got an investment strategy that can fit in great times in the market and not so great times in the market. Wonderful. If you don't have one, if you need a CFP that can do those things, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.